Hello, everybody. Thank you for joining this webinar. I will focus on the new features in the new 3.9 version of Invest for Excel. So this will not be a comprehensive presentation of the model or what you can do with it. It will be focusing on the new features in version 3.9. We will be doing this for about 45 minutes. You have a possibility also to write questions, and I will answer when I have the time and I notice the questions. I'm alone. I don't have any other here with me. Okay, we're about to begin. And let's see, like that. So just very shortly, a few words about Data Partner. So we are a family business. We have been in business since 1987, so like 33 years, and we focus on this narrow segment. So it's software for investment appraisals, financial modeling, and valuation. We're based here in southern Finland, in Porvoo, east of Helsinki, but we also have local partners in many countries, some 35 partners that locally train and consult and sell and support in local language. We have more than 1,750 corporate customers in 56 countries currently. And we focus really on this one product currently, this Invest for Excel product, and offer also training and consulting services around it. And we have customers from most industries, so it's really not industry dependent. But the biggest customer segments are electricity and heating, like local utilities, energy companies, and then professional scientific technical services like engineering and consulting companies, pulp and paper, real estate activities, chemicals, food and beverage, transport and logistics, metals and metal products, and so on. So those are the biggest customer segments. And here are some of our more famous references from some of those industries. But let's go forward to the main thing. First, a word that you will receive this presentation by email afterwards, and you will also receive a link to the recording of this webinar. So if you miss something, if you have to leave early, or if you just need a little bit repetition, so then you can go back and look at the video. So yeah, we focus today on the new features in version 3.9, and they are listed here. So there's a function to add financial ratios to your calculations. There's included a DuPont Analyses, a feature to, by pressing a button, you can update all analyses at once to keep them updated. We have added the indicator of net present value as a yearly annuity. We also now have a feature that you can select to automatically turn on iteration on your calculation when you open it, if you have a calculation that requires iteration. And one nice feature is that also now with the new version, you can just click the workbook and it will open Invest for Excel automatically. You don't need to go to Invest for Excel program first and then open the workbook. You can do it. You can do it the other way around. Then a feature called Save as PDF, which really is more like a PDF report generator. So you can create PDF reports to your liking. We will look at that also. You can hide or unhide some key financials in the analysis. And we have changed how debt residual correction is calculated. I will explain that later also. And now also we have for online activation, we have like a online licensing system that makes it more easier for you to manage your licenses. Okay, let's get started with the first new feature. So it's called Add Financial Ratios. And you know there has been this key financials page in Invest for Excel for some time. And by default, it's empty. So you can have the possibility to add your own ratios, industry-specific ratios, or some ratios that you're missing. So you have the possibility to name them and make an Excel form linking to the right places. Now we also have automatic ratios. So there is a new button here, top left, to right of the leftmost button. There is a percentage button. When you press that button, you get a list of key ratios that you can add to your calculation. So you can select which ones you want to include, or you can select to include all. Like in this picture, they are all included. Okay, it continues. They don't show all on this page. And they also come with explanations. Okay, but let's look at it in practice. So I will switch over to the program, which is here, and let's open a file. I will go to IFA file and open example file. So there is open your own workbooks and open example files. There's a few example files. There's an acquisition example, an airline business modeling case, and machine investment calculation, real estate calculation, a wind power plant. They are simple cases, but now I choose the acquisition model. And because when it's a complete business, then you have a better representation of the key financials. So I go to input. Okay, I can just show through also the case. So here is 10 years annually, and there is a income statement with historical numbers and forecast, working capital, cash flow statement, balance sheet. So I can also just close the detail view like that. To have an overview, this is the balance sheet, and the next page should be the key financials. And in this example file, here are some manually made ratios included as an example. So this is not the new feature, but if I choose, like, let's leave one empty row, and then I go for the next row, and I press this percentage button here, and now it opens this Add Financial Ratios dialog box. And I can here choose which ones to include, like this, or I can choose to select all. And by default, it also offers to include category headers, like here is ratios for liquidity, ratios for turnover, ratios for profitability, for business risk, for financial risk, and still there is, I think, one more, stability here. So then it will make headings for those, and also include the formulas, so that you can easily see how they are calculated exactly. And here you choose also which is the first row to start inputting, and it offers the one which I selected, the 879 row. So Yeah, guess that's it. So I press OK, and it brings them here, and it will show the ratios in my model. And so you have the headings, the category headings, you have the ratio name, and you have the formula. The formula explained, and of course the formula itself here. So when it says current assets divided with short-term liabilities, so here you also see that it's 802 divided with 838. And when I press this button with like a picture of a workbook, it removes the ceiling, and I can go up and see what if I click yes, and I see here are the short-term liabilities, and there are the total current assets. Those two, just by clicking, it shows me which ones. And okay, now I don't have row and column headings, but I can get those by pressing this button here below the camera button with this grid. So now I get the rows and columns also. So it makes it even more simple. So there is no mystery. They are described in words, and the formula also exactly clearly visible, and you can track it. Now, many of these ratios, they are best used for business planning, for budgeting, for financial forecasts, for valuation of companies, for forward-looking financial statements on company or group level. For individual investment projects, they are not always so good to use, because if you don't include financing, they would give a little bit biased result. So it's not maybe correct always, because you know how Invest for Excel works in a normal investment calculation. You have a negative cash, and but it's not counted as debt. It's just negative cash. So it can give a little bit wrong. Some ratios like liquidity ratios would show too good. And so, but of course, including financing would make it also perfectly usable for investment projects. But without financing, so some ratios are not perfect. Just I wanted to point out that also. Otherwise, I don't think here is anything special about it anymore. I'm not going to go through all these ratios. We don't have enough time for that. Okay, I will put back the ceiling or whatever you want to call it, so that it jumps nicely from page to page. And let's go forward. That was the first new edition, and I will go forward to the next one, which is DuPont Analyses. And so it's sort of related. It's also about key financial ratios for calculating return on assets and return on equity. But the nice thing with this DuPont analysis is that it sort of describes the whole path on how to calculate, and gives also like a better understanding on how they are calculated, and how different individual input values impact on the profitability on assets and equity. So okay, let's go back again to the case that I have opened, the acquisition case, and also I see it's not here included in the model by default, but when you go from the menu Analyses and DuPont Analyses, this button with a lamp to shed a light on these indicators. So now it opens in an extra sheet called DuPont, and it by default it shows a shorter version. Also because of the same reason, like the longer version requires financing to show correctly, but the shorter version works also with normal investment calculation without financing. And so you choose here, if I choose ROA and ROE, return on assets and return on equity, then it shows the longer version that calculates both return on assets and return on equity. But now let's start the shorter version and look at it, how it is calculated. So basically, return on assets is like profit margin multiplied with assets turnover. But how do you calculate profit margin? Okay, it's you start with calculating gross profit, which is very simple. It's operating income, total income, minus the variable costs, like operational variable costs. You get the gross profit 1.3 million in this case. And then you deduct other operating expenses, which is fixed cost plus depreciations plus other expenses, and like extraordinary expenses, yes, in this case. So that's the total operating expenses plus gross profit minus operating expenses give EBIT, and EBIT 1.1 million. And to come to net profit, you deduct the interest costs, financing costs, net financing costs, the taxes paid or received, and other expenses. So then you get the net profit. And also here you see where the program is linking. So if you really wonder what is this other expenses in this case, you can go to look at row 523, 527, 531, and 532. So I would think it's extraordinary, but 523, what if I double click, would it show? Okay, now I don't have this open. Go to income statement. 523 extraordinary incomes, yeah, that was the first one. And here are the other ones. Changes in appropriations, deferred tax and minority interest. So also very easy to see what is built of. Okay, that's the total net profit, and net profit divided with operating income, so total income. So it's like, that's the profit margin. It's 2%. Net profit is 2% out of total operating income. That's the profit margin, and then we need to find out the assets turnover. So we have, to calculate assets, we first combined cash, account receivables, inventory, and other short-term assets, and they are together all current assets, and all current assets are added to fixed assets, the book values of fixed assets. So the total assets value is 12,123,000. And so we have the operating income, the same again, the full total income divided with assets gives you the turnover. So it's 3.5 times assets during a year, and 3.5 times 2% margin gives a return on assets of 7%. So that's how it was calculated. Now let's look at the return on equity, which is, I guess, more interesting. But again, to get the return on equity, you need to have the financing modeled, which usually is done in the enterprise edition of Invest for Excel. It can also be done in like Pro version if you do it Excel-wise manually. Then, okay, to calculate the return on equity. So we have, first of all, we calculate the equity plus liabilities, and the liabilities, accounts payable plus notes payable as like short-term debt plus other short-term liabilities give the total current liabilities plus non-current liabilities can give the total liabilities of little less than 5 million. In the equity, we have the beginning equity plus capital change plus the profit of the year gives the total equity And equity plus liability is liability plus equity, a total 8.7 million. And this total equity plus liability is divided with equity. So you see like what's the equity part. So the total is 2.3 times equity. So that's leverage. And then it's simply the result of return on assets, 7% multiplied with the leverage 2.3 gives a return on equity 16.3%. And this return on assets and return on equity, they are annual indicators. So they are not for the whole project or the whole term of modeling. That's important to remember. So it's not the same as IRR or IRRE. It's annual ratios. So you choose a year and you get different number. Just like the key financial ratios that we looked at, they are also annual ratios. So there is different value for every year calculated. Same is for return on assets and return on equity. Okay. Yes. So I think that was the DuPont. And of course, you can always print and take a snapshot, copy to paste it to some other document or file. Let's go to next new feature called update all analyses, and that's really a simple thing. So I'll go back to my Excel file, and there are different analyses for discount rate, for investment amount, for income, for variable costs, for fixed cost, and so on. And they are updated when you come to the page for menu or with button. Otherwise, they are not updated, unless, of course, you have a setting. You can choose other options and other options again. Then you can select update analysis charts automatically. That would mean that they are always up to date. But if it might slow down your work, because every time you make some changes, they are all updated. So that's why it's not by default selected, and I don't have it selected. But if you want to be sure that you always update the charts, then you can have it selected. And if you don't have it selected, so now there's a new button called Update All Analyses. So just press there when you want them updated. So now this is how long it takes to calculate through all analysis on my computer. Of course, it depends on how big your model is or how fast your computer is. That was that, and then next new feature is net present value as a yearly annuity. We have included net present value as a monthly annuity, and it has been asked why not have net present value as a yearly annuity also, and now we have that also added. And why are these needed in the first place? It's because when you compare calculations with different term, then net present value is not comparable. And in cases where you consider when to replace some old asset with a new one, and you sort of looking for timing of when to invest in a new one, when to replace the old machinery with a new one, then you have two calculations. One is to continue to maintain the old equipment for a couple of years more, and the other calculation is to invest in a new one. Now, first of all, there are different calculations. Let's say you have 3 years for the old equipment and 15 years for the new equipment. And the other thing is that for the old equipment, you cannot calculate internal rate of return or payback, because there is not a negative cash flow in the beginning, so it's not calculatable. So you need to rely on net present value as the only indicator, but you cannot use it directly because you can't compare a 3-year net present value with a 15-year net present value. But net present value is a monthly annuity, you can compare, and net present value is yearly annuity, you can compare. So if the maintaining of the old machinery gives a higher yearly annuity or monthly annuity, then stick with the old one for 3 more years. But if the new one gives a higher monthly annuity, then go to the new one as soon as possible. And let's look at this in the program also. Go to result sheet, and I can hide that residual value, and let's look. Here they are. Net present value as a monthly annuity and a yearly annuity. So it's this net present value sort of divided per month and per year, which yearly payment over 10 years would give the same net present value. And the yearly annuity is not by default visible. So you would have to go here top left in this button, which is on every screen top left, where you can choose which rows to show and which to hide, or you can rename rows. So this button is on every page. So now so we see if it's white, it's visible. If it's blue, it's hidden. So there are some hidden rows, and now I can sort of hide the yearly annuity, and I can make it visible. Where was it? Oh, it's lower. Yeah. There. Okay, like that. Okay, we need to go forward. Next new feature is turn on iteration. So in cases where when your model requires that you have iteration, you can put on iteration, and it will work. Let's say you have some excess cash and you want to have a return on that cash that you always invested and get some interest return on it. So it doesn't work unless you put iteration on, because you need to take the rows from the same column, and they are impacted by whatever the result is. So you need to have iteration, and then it works. But then next time you open the file, iteration is not on unless you go here and put the setting that turn on when you open the file next time. So then it's automatically on. And yeah, let's look at this in practice. In this particular case, let's make we go to income statement, and I go to other interest and financial income and make a formula. Let's say we get 2% return on excess cash, and I go down to bank and cash. 4,079,000, and now it warns me there is a circle reference. Okay, and it shows like this with this line. So now it can calculate. Then I go to other calculation, turn on iteration with the first one at a time. Okay, that's fine. And the problem is resolved. So now it calculates an 82,000 interest income on the excess cash for me. And if I go to other options, and turn on iteration when opening, so then it remains, the iteration will remain on this workbook every time I open it. So that's why and how it works. And of course, it would work the same way for interest costs. So if you have a negative cash, so you would put it as a short-term debt and then put interest costs, so it would work. So this way you can model financing automatically in your business planning. Okay, but we are running out of time. Let's go forward. Invest for Excel is opened automatically. Actually, pretty nice new feature. You don't have to go to Invest for Excel and open the program first and then open the workbook. You can just click on the workbook and it will offer to open it automatically. Let's look at this in practice also. So now I will close Invest for Excel, and I will open some calculation. Let's take that one. So now Invest for Excel is not open. I just click on the workbook and it says Invest for Excel is not open. Do you want to open Invest for Excel? Yes, I want to open Invest for Excel, and it opens the program and the workbook. Simple but nice. Now this works for the workbooks created with version 3.9 and newer. The old workbooks, it doesn't work on. You have to open the same way as before. But every new one you will make, so from now on will include this feature. Okay, we go forward. And next new feature is Save as PDF, which is really like a PDF report generator rather than a save feature. Of course, it saves the report, but as a PDF file. Let's look at that. Okay, I have some file open, and from the menu, if a file, and save as PDF. So now there's really 4 different options. Save as PDF, and the front, it offers like all sheets in your model. You can select them all, or you can select specific sheets or all. You can also move them. Let's say you want to have the cash flow analyzed. How do I do it? I haven't tried this. Yeah, like this. You want to have a specific place, you can move it or move down. So you can change the order of sheets in your report. That's nice. Okay, select all. So now it will create a report on all these sheets. Then there is another option that you can have more detail. You can select exactly which pages, which reports to include. We will do that next, but let's do this one first. So the whole workbook, can press Save as PDF and it starts creating it, publishing it. Like that. So it's a PDF file saved in the same folder and the same start name, but then with the date stamp, timestamp, actually very detailed. And you see here it's the basic valuation, contact information, next page investments, income statement, working capital, cash flow statement, key financials, balance sheet, profitability analysis, and all the analyses and so on. So it takes all the sheets and reports. It's the tornado, the DuPont, the cash flow chart, and so on. Let's go back and make the other version. So I go to my file back again, and I have to choose again if a file save and save as PDF. And this time I don't choose the first page, I go to the specify. So now I get to choose exactly maybe I don't need contact info, but basic values only. And then I want the investments, income statement, investment income statement. Don't need working capital, I want cash flow, balance sheet, not key financials. For the result, I want the income sensitivity. I want those. And that's it. So now it will only include those selected. And I can still change order here. I choose one and then I move up or move down. And then just save as PDF. And now it creates this report, which is more exactly planned as I wanted. Yeah, so only basic values, but not contact information, investments, income statement, not working capital, but cash flow statement, balance sheet, profitability analysis, sensitivity on income, tornado chart, DuPont analysis, cash flow chart, and that's it. Exactly the ones I wanted. Okay, let's go forward. And the next one is hide, unhide key financials in Analyses. Okay, so Analysis, you know, is these pages and the key financials is the lower part of the Analysis, which shows key ratios for a specific year. So let's go and look at this feature. Let's switch to the other file with more ratios. Open example file acquisition. Okay, I didn't save it, but let's just simply go and add ratios. And I go to the analysis. Let's look at income analysis. It's slightly bigger, like that. So you see, this is the normal. You have the sensitivity for incomes, plus minus 20%, impact on net present value or whatever indicator you choose. But the upper part is for the whole life cycle, for the whole term of the project or term of the valuation or planning. But on the lower part, there is annual ratios for selected year. So that in the middle, there is the planned case, and then it's worst case and better case, and how it will show up on a specific year. And it offers some standard, but then you can, of course, choose whichever ones you want to include from the long list of ratios. But sometimes you don't want to include these. So now the new feature is that you can, top left here is a new small gray button with 3 dots, very familiar looking button. And here you can choose how many rows to include. Minimum is 0. And I can also choose if it applies for just this particular analysis or for all analyses. Let's make an example where I want to include exactly two ratios, like that, for all. And I choose them. I want to have like some liquidity ratios, current ratio and quick ratio. So now, yes, this is exactly how I wanted it. A simple, clear analysis with only the ratios I wanted to include for a specific year. Looking good. And of course, snapshot would take only this one. And now, because I chose that it will impact all charts, so it impacted all charts. Also, handy feature, make your modeling even more simple and more accurate. Okay, we're running out of time. Let's go fast forward. Debt residual correction for calculating free cash flow to equity. You know, this free cash flow to equity feature is only in Enterprise Edition. And if you look at the result page here, so the upper part, which we normally look at that in investment appraisals, investment calculations showing net present value and IRR and payback, is without taking into account the financing structure of debt and equity. But if you go to other options and include profitability calculation based on free cash flow to equity, FCFE, then you would also see the profitability from the owner's point of view, the return on equity. You know, it's different. The project's profitability, the company profitability, different from the owner's profitability because there is a debt leverage. Maybe you can get a higher return on your small portion of equity when the rest is financed with the debt with the lower interest. So you get a leverage there. So it increases your return. So when this is selected in Enterprise Edition, you would have the normal view and below that the owner's return. So it's based on free cash flow to equity. So what is left when the interest costs, the financing costs are paid and the loan amortizations are taken care of, then the rest can be used for payments to owners. So it calculates here the net present value of equity for owners, which is the different discount rate, which is like higher. Here is 7% WACC for normal for the business as a whole, but owners want a 15% return, and yet it's positive net present value of 1.4 million, and a return on equity of 46.6%, and a payback time of less than 5 years. So really nice numbers. And here, the new feature is regarding this debt residual correction. So the idea with the debt residual correction is that you can't trick the result by just taking debt and not repaying it. So whatever debt you have at the end, it will be deducted here. So let's say if you let's take some debt here during the project. Here in 22, I will take 9,990,000 debt, and I will not repay it. So how will that show up here? Yeah, there is debt residual correction showing up. The value 2.472 is the net present value of 9,999,000 discounted with 15% discount rate for 10 years. So this is the 9,999. But there was also debt from the beginning. There was an opening balance of debt of 1,359. And that didn't show up. And that's the new feature, because that was taken before this forecast, before this planning. So it should not be deducted. It has not been taken for this project, for this new investment. It's a sunk cost. So that was not deducted. So you see there is 1.3 million. What if I go and take back, remove that 999, and I go to the debt again, and we see that there is still 1,359 million at the end, but it's not deducted here in residual correction. That's a new feature. Just gives a more correct result when you make, especially when you make business planning, like when you're mixing investments and business planning, like very often is the case. So, and you take debt for the new investments. So that debt should be deducted, but not the old debt that your business has from before. Okay, we're running out of time. So that's only the online license management. So now you can, first of all, you don't need to have a USB key for your license. You can have a new type of license, which you just, when you start it first time, you add the code and then it's activated. And then if you ever, when you get a new computer, you go to the old computer and deactivate your license, and then you start programming the new computer and activate it. Or if you have there's some changes in your organization and another person will take over your license, then you go and deactivate here, and the new person activates on his computer. So now it's really simple. Simply manage the licensing. And it can also be done offline. All of this requires internet connection, but there is also methodology how to do it offline. And it's described in this what's new document that you have access to. Or if you don't have it, then just simply ask for it. So here it's described also how to do it offline in this document. All right, let's take a look. We have I think we are about ready. So do you have any questions? No open questions. Now if you like, please type any questions. I will answer. And this has been recorded, and so I will also send you a link to the recording, and I will send the presentation file. Yes, maybe not the calculation files. Basically, you have the acquisition, and the other one was just something. So, but those two, the link to the recording and the presentation. So thank you very much for attending. It has been a pleasure to present the new features, and we stay in touch. You can always contact if you have any more questions about the new features or program overall. And hope to see you soon when the situation changes and we can have live workshops again. Thank you. Have a nice day. Bye-bye.